So to summarize what I was saying, there's one thing I wanted to say just a second ago, and I'll come right back to this. But whenever you have the daily chart and the market gaps up on the open, especially when the market, you have a sell climax, 2 legs down, and you get a gap up on the open, there's added risk if the market's at support that the day can be a bull trend. And here, when you see this kind of a rally right here, I made the comment about this slide. When you see this kind of a rally where you have good higher time frame context, let me go to this one first. Good higher time, this is bad higher time frame context right here. So we have a bull trend from the open after a gap up, but the rally is testing a 60-minute high, and therefore there's greater risk of getting a reversal. Here, when you have this gap up on the open is this buy climax here on the 240-minute chart, and this is coming later in a rally, and it increased the chances of a bull trend lasting a good portion of the day. And so the point I'm making is this: whenever you get a gap up and it makes sense for the market to rally, it can go for a lot. When it makes sense on the higher time frames, it can go for a lot longer than what seems reasonable. So when you see a parabolic wedge, always pay attention to see what the higher time frame context is. You had a rally, it's okay to buy, and you could basically buy below any of these bars. And then because this channel was so tight, when you got the sell-off, it was a trend line break, and the odds were we would get a second leg, which we got up here. And then I mentioned 30, 31 strong enough for a second leg, 33 high one buy. Good bar for the bulls, but probably 34, not a strong enough reason for the bulls to exit, therefore probably buyers below, scaling in lower. And then we got a second leg up on bar 35, good bull bar, but a doji. 34, probably going to pull back. 36, bear bar. After consecutive buy climaxes, I think it makes sense to get out of longs below 36 and look to buy a pullback. 37, consecutive bear bars, 36, 37, probably going to get a second leg down. And then 38, 3 consecutive bear bars, probably sellers below. 39, bull bar, reversal up, but after 3 consecutive bear bars, it's a weak high one buy. And therefore, if there might be some traders buying above, but there's also probably traders buying below the bar as well. And then we got a bear bar, 40, but probably buyers below. 41, another bear bar, but a close above the midpoint. 1 second here. Not a good buy above 41, but I suspect we probably will get a bounce. Low one, short 42, probably buyers below, and then a doji 43. Not quite at the moving average, and you can see what happened with 44. 44, we rallied and reversed down. One of the problems was 42 and 43 is not a good buy signal bar, but it's also not touching the moving average. And so far, we're 44 bars from touching the moving average today in a fairly climactic rally. And therefore, that actually lowered the probability of 44 becoming successful. Bulls, they see 44 as a pullback from the breakout. We had a bull breakout, and then we pulled back intra-bar, and bulls won a second leg up, test above the 36 high. Bears see 44 as a breakout pullback sell and a retest of the low 2, the low 1. We had a low 1, 42. We pulled back, and we're retesting it during 44. Bears want trend resumption down, and that's ultimately what they got with 45. 45, strong enough bar, probably going lower. 46, follow through. Not a good sell to close bar, but not a great buy above either. So therefore, probably sellers above, scaling in higher, which means you will have some bears selling, betting that we go lower. 47, bear bar, good for the bears, but a tail 46, you will have bears selling and scaling in. And then you can see that's what happened on 48. Instead of selling the close, a lot of bears sold above the bar. Some bears sell the close and above the bar. 48 outside down, but consecutive sell climaxes, getting near below the midpoint of the range at this point. Probably more traders buying down here than selling. And then 49, bull bar, but not a strong reversal bar. Probably sellers above, but the sellers may not be at the high. The sellers might be at a bar range above. And that's why I mentioned that it's reasonable for always in bulls to exit, always in bears to exit above 49 and wait to sell again on reversal. 50, bull bar, close below the midpoint, not a strong reversal, so probably sellers above, and you'll have some bulls beginning to sell again, but a low one short with a bull bar, probably buyers below. 51, triggered the buy below 50 and reversed up, but not a strong buy above 51, and therefore probably more traders selling the close at 51 rather than buying it. And that's what happened with 52. 52, bear breakout, closing on its low, probably going to go at least a little bit lower. And then you can see 54, we reversed up for the bears. For the bulls, they saw 52 as a second leg down. We rallied, sold off on 51, rallied, sold off again 52, below the 49 low support, and we were rallied on 53. 53, bull bar, good for the bulls, but a little bit of a surprise 52, so we may try and get a second leg down. And you can see that's what happened with 54. 54, bear bar closing on its low, good for the bears. What about selling below 54? Well, selling below 54 is tricky because theoretically you have bulls who bought above 53 and they may have a stop below the 53 low. And generally, you want to sell in an area where bulls are going to sell out of their longs. And because 54 is right above an obvious stop location for the bulls, the 53 low, you'll have some bulls buying the close of 54, putting a stop below 53, betting that the market will hold. And therefore, I think it makes more sense. Plus, if you're a bull and you bought above 53, your stop is only a few ticks away at this point. I think it makes more sense to wait and see what happens to exit below the 53 low. And you can see instead 55 formed a strong reversal bar, trapping the bears who sold below 54. Strong reversal, probably going at least a little bit higher, and then follow through. And you can see 57, 58, more follow through, no reason for the bears to sell, and therefore bulls will continue to stay long. Broke to the upside, we got more follow through 60, but now it's becoming a little bit climactic with 60 and 61. Buy climax 57, pause 58, buy climax 59, 60, and then a third leg up on 61, 62. 62, not a good sell signal bar, so might be more traders buying below. And then we went outside up 63, but 62 and 63 are a warning that something is not quite right with the rally. We have a breakout channel, so a spike 55, overlap 56, 57, so it's a channel, and then we got a new breakout 59, and now we're forming a channel 60, 61, 62, 63. And so what are the chances we get a new successful breakout? Well, it's probably low probability, and if we do get a new breakout above 63, it'll be 3 legs up. 64, 65, another leg up, but tail 63, tail 64, tail 65. This looks more like a vacuum test of resistance, the 44 low, than the start of a new rally. 66 reversal down, probably going to go mostly sideways. Not a great sell below 66. It's an inside bar and a fairly tight bull channel, but an overall trading range, we had a rally, deep trend line break, and this might be a lower high, major trend reversal. And then we have 67, a weak high one buy, and you can see we got sellers above it on the second leg down. The bears, they see it as a micro double top, 65, 67, reversal down 68, and they want a strong sell to close finish. 69, 70, good for the bears, but tail below 69 and then tail below 70. 70 is also a bigger bar than 68 or 69, and therefore that's a sell climax, and that increases the chances of more profit taking down here. And then we have a tail on 71, probably going to go sideways to up. And then instead of just going sideways to up, we ended up getting a relatively big bar on 75 and then followed through 76. And that led to a small second leg up on the 78 close. So overall, good day for the bulls. For stop entries, I mentioned that you could buy above 1, you could buy above 2, you could buy above 3, you could buy above 6, really any of those bars. And then where do the bulls get out? I think that's really what's more important to focus on instead of what bar to buy above. Because the reality is, if you're long, it doesn't matter if you buy above the 2 high, the 3 high, the 6 high, the 8 high. If you're long, it doesn't matter where your entry is. What really matters is your risk, the market price to your stop. And therefore, buying above 17 and being long above 17 is the same trade. The bulls, they could buy above any of these bars. Some might get out below 9, but they know 9's a minor reversal. And because it's a minor reversal, they're going to be pretty quick to get back in. And then bulls, it's okay to be long. I think they get out below 24 or above 25 or below 25. Excuse me. They either get out below 24, above 25, or below 26 if they understand the logic. Strong enough breakout 24, bad high 1, probably going to go at least a little bit lower. But if they do, they probably look to buy again around the moving average 28, 29. One thing to understand is when you're trading, well, let me finish what I'm saying, and then I'll explain it more if it'll make sense. Bulls, they can buy 29, 30, 31. They probably get out. Some get out below 36, 37. I think more get out below 38, and then obviously a lot started getting out as 44 started to reverse back down, and 45 broke below the moving average. Bears, they can be short. I think they probably get out above 53. They definitely get out as 55 starts to reverse up. Bulls that are long, I think they can get out below 64, and I don't think they have to buy again, or they get out below 66, or as 68 fails to trigger the buy above 67 and reverses down on 68, or they get out during 69. And then if bulls are really determined and eager, they buy as 75 reverses up. One of the things to understand is the stronger the trend, if you have a signal bar against the trend, like bar 9, it's not really all that strong of a sell, and therefore it's a weak reversal. And therefore, the odds of it leading to a major bear trend are really small. But bulls, what they'll do, plenty of bulls, they'll exit below 9, confident that the market will probably at least go sideways for a bar or two. They'll wait for the market to go sideways for a bar or two, see what happens, and if it doesn't do anything, they'll buy again. And you can see that happens just all the time. If you sell below 4, you see how 5 sells off, pulls back. But even if you took that trade, you could still get out during 6. So what's the point I'm making? The point I'm making is this. Always when you're thinking about, you hear Al talk a lot about how I would get out below a bear bar, or I'd get out above a bull bar, and then I'd look to re-enter. Well, one of the things he's assessing is the strength of the leg. The stronger the move and the more clear the move is, the more you'll have traders just hold. And therefore, there's plenty of traders, they'll look at 9 and they'll just buy below 9 because they believe that it's the start of a small pullback bull trend and the reversal down is going to be minor. Same thing with 24. They'll look at 24 and they say, yeah, 24 bull break out of a bull channel that's failing, but it's such a tight bull channel and a small pullback bull trend. Who cares? I'm just going to hold long below 24 because I'm confident that it's probably a minor reversal and it'll lead to a trading range and I can get out at back of the high of the day. You'll have other traders who they understand that 24 is actually a reasonable sell for the bears. And so what are those bears going to do? Those bears are going to sell. They'll sell below 24 because they understand it's probably going to get at least a small second leg down. Now, even though they're selling below 24, what do they expect? They expect the sell below 24 to ultimately fail. And therefore, they expect that they're going to scalp out of the position. And therefore, bears, they sell, and they see this, and they start to buy back their shorts quickly. What are you going to do if you're a bull? Well, if you're a bull and you can kind of understand both of those aspects at play, one thing you'll do, you'll exit below 24 because you believe it's a reasonable sell for a small second leg. You're going to wait to see what the second leg looks like. And when the second leg starts to fail to the downside and starts to go sideways, what do? You buy again. 36, probably strong enough bar for a second leg. You get out below 36 and you see that this 36 signal bar is increasing in strength. It's getting follow through. It's getting an entry bar 37, another entry bar 38, and therefore you might end up going short. So what's the point in that? The point in that is, I think it's really important. This is one of those things about having, it's something called calibrated expectations on a trade. And an easy way to understand that is it's really important to have a reasonable expectation behind what it is that you're looking for. And one of those ideas, when you look at a stop entry, we think that 40% of stop orders are successful. And that's actually it's actually not an accurate statement. Why is that? Does anyone understand what I'm saying? So why would saying 40% of stop orders are not successful? Or let me back up. Why would it make sense to say, let me just start over, 60% of stop orders are not successful? I'm saying that that's actually kind of not a valid statement. Why is that? Why am I saying that's not valid if Al says it's valid, that 40% of the time a bar like 9 will be successful? The point I'm making is I'm not saying Al is wrong. What I'm saying is you have to define what success actually means. If your success is that bar 9 is going to lead to a bear trend, it's not a 40% probability. It's probably a 30% probability. If you're betting that 36 is going to lead to a bear trend, maybe it's probably not even 40%. So what it really means is when you look at these stop orders, when you start thinking about a stop order and defining the odds of it getting a second leg, you'll start to understand most stop orders actually do, in fact, get some kind of second leg. And the more you can understand the context at play, the more you'll see it. Where was the second leg on bar 10? Does anyone see it? Bar 9 was a reversal bar. What was the second leg down on bar 9, after bar 9? 13, exactly. So if you understood that and you understood the fact that it might be a small pullback trend, if you sold below 9, you're disappointed with 10 and 11, you're going to get out break even on 12 or 13. And if you're going to get out break even on 12 or 13, what are bulls going to do on 13? They're going to look to buy. That's something that's really important to understand. All right, for limit orders, bull trend. So buyers below, really any of these bars. You can buy below 9, you can wait for the second leg down, buy below 12. I thought buyers below 24, but the buyers are probably closer to the moving average. So don't buy the 24 low, buy closer, buy the pullback. In other words, buy down here. And I thought sellers above 32, but the sellers probably won't come in until maybe a bar range above. So it's not sell the high, it's sell somewhere up here, which means in a strong bull trend, it's really a better exit, take profits up here and look for a pullback. I thought sellers above 39, but I'm not going to take the trade with it being a tight bull channel. And I thought sellers above 47 for a second leg down. And then I thought buyers below 51, but I thought we would also fall below the 49 low. And then I thought buyers below any of these bars, even though it didn't trigger. And then 62, it's a little bit high in the range, so not ideal. I thought buyers below 72, but late in the day, probably better to do nothing. Buy the close, sell the close. You can basically buy any of these bars on the way up. Buy the close of 3, buy the close of 4, buy the pullback. Most of the time, when you see a buy or sell the close, you're really better off buying or selling the pullback. So when you see a bar like 3, wait for the reversal attempt on 4 and 5 and buy the pullback. When you see a bull bar like 8, don't buy the close, buy the pullback. And an easy way to understand that is just take a look and see how often bars overlap and how much of pullbacks you often get. So when you see a bar like 16, 15, 14, don't buy the close, wait for the reversal attempt, buy the pullback. I thought buy the close 30, you can even buy the close at 31 if you're quick to manage trade. I thought 45, sell the close. 46, technically sell the close, but I'd rather wait to sell a pullback. So in other words, wait for something like 47 and then sell the pullback. And then I thought probably buy the close 55, 56, not ideal. Buy the close 57. Not ideal because it's not all that clear yet, but I thought the odds were reasonable for a second leg up. And then for strict buy the close, sell the close, that's probably it. You can argue up here, but it's really not all that clear. Let me take a look at questions. Okay, during bar 72, you mentioned it was too low in the range. Why was bar 72 too low in the range and not bar 54? Well, 54. So a few things. One, I thought that there's a couple things going on. 54, we had a bear breakout second leg, and 54 closed on its low, and it's channel down's tight. It's reasonable for the market to test lower. And I thought that the bulls who bought above 53, the bull bar, when they see 54, that's a little bit of a problem for the bulls. The bulls are trapped. And if the bulls are trapped, then it makes it a little bit difficult, because what are those bulls going to do? Well, they've got to be prepared for the possibility that 55 is a bear bar closing on its low. In other words, the possibility of getting a bear break out of the bear channel and a sell-off back to the high of bar 1, a bad buy signal bar. So I thought the risk was we may have to get one more leg down in some kind of sell climax and then reversal. But I did think at the same time that even if we broke to the downside, if a bull bought and scaled in, we'd probably get back to the 53 high. And then over here, you were asking about bar 72. We had a decent rally late in the day, and we had a sell-off, but this rally is strong enough for a second leg. And this sell-off, even though it looks good, there's a lot of overlap. And bar 72 is a low one with tails 70, 71, tail below 70, tail below 71, tail below 72. That makes me think there's realistically more buyers below. And therefore, I thought that the risk reward is bad. And most of the time, when you're at bar 72, if the market's going mostly sideways, usually it's going to remain in sideways for until the close. In this case, we bounced, but it still remained an overall trading range. Okay, question, is bar 73 a good buy without yet having bull bodies? Yes. Well, bar 73, it's what I just talked about. The always in bulls. Well, okay, let me explain it like this. So what is the limit order buy? What's a limit order trade? A limit order trade is actually, I want to think about it from the standpoint of always in. And as you know, I try and talk a lot about, one of the things I'm a firm believer in, and I've seen this with other traders that's really, really helped them, is I think it's important to think in a kind of a rule-based method. So trade one method, one idea, and get really good at it, and then trade other methods. So really, really understand stop orders. I think that's really important. And an easy way to do that is some form of always in. And therefore, I mentioned always in bears get out below 68 or 69. The bears are out, and then, always in bulls get out below 68 or 69. Bears are short. And then I made the comment that 70, 71, and 72 is not what the bears need, and therefore bears, they'll probably buy back their shorts, and therefore bulls, they'll probably start buying down here. And because of that, it increases the risk that you'll get a stop entry at some point. Now, a lot of times in a trading range, what happens is traders are aggressively selling, but then the momentum slows down and they buy back their shorts. And that's what leads to a pop like this. But overall, that is the reason why I thought that we would get a bounce. How can I learn to read price action bar by bar? Well, if you spend enough time looking at charts and being interested in charts and thinking about charts, you can eventually get to where you can read them pretty well. That's really the answer. Wish I had something more simple. Now, so really, I think the question, that's not really an intelligent question. And I don't mean any offense to the person that asked the question, but it's a poorly asked question. How do I become good at reading bar by bar price action? I think what the more intelligent thing to ask, and the reason why I say intelligent is trading life is all about asking good questions and thoughtful questions. And I think there's a this is something from that I heard from Ali, and you actually all heard it in Orlando. But first principles thinking, you can Google Elon Musk interview, first principles thinking, and basically formulate your questions in a way where it's going to ask a good question. How do you become good at price action is not really a great question to ask. A better question to ask is, I would think more from the standpoint of what you're trying to achieve. So obviously you want to be profitable. So think to yourself, how do I become profitable? And then the answer is, then you have to work down the path of, well, what do I know about the market? The market contracts and breaks out. In other words, you have volatility expansion, a breakout, and you have volatility contraction, a trading range. In other words, the market cycle. The market cycle breaks out, and then the market cycle starts to go sideways, and then it forms a trading range. And based on that first principle of knowledge of how a market moves, which is clearly stated in Al's books in the video course, we start to ask ourselves, what do I know about a breakout? Breakouts often get second legs. And then you think through, what's a breakout? How do you define a breakout? And if you can define a breakout properly, you've got to give it some form of a definition. Then you start looking at a bunch of breakouts and seeing, does it get a second leg? Well, how do you define a second leg? You've got to define what a second leg means. Is a second leg one tick above the bar? Is a second leg, an actual leg one, leg two, like leg one, pause, leg two? You've got to define what that means. Then I'm willing to bet if you look at if you take 100 examples of breakouts that you define in second legs, you're probably going to start to realize that most of those breakouts get some kind of small second leg or retest the close. Then if you start to add a leg counter in there, you start to realize that most breakouts in leg one and leg two actually are successful. And then before you know it, you actually have a trading strategy that you could trade with. So the funny thing is that's a lot of work to do, but I just explained to you a pretty reasonable way to have a trading plan that actually works. And that involves breakouts and second legs. That's really all you'd have to do. There's a lot of work involved in that, but all you'd have to do is go back to Al's books and video course, and he clearly states what's a strong breakout. And that would give you a really good starting point, but that is exactly how I would do that. Okay, question. When you see bars like bar 46 with a huge tail at the bottom here, does that signal to you uncertainty and best to stay hands off? I sold it, and then 47 here gave me a nice profit, but it was really a chaotic trade that I exited feeling like I got lucky rather than made a reasonable trade. I wouldn't say you got lucky. Well, okay, two things. So let me talk about your trade. Let me go back to what you just said, because that is actually a problem. I sold it and 47 gave me a nice profit, but it was really a chaotic trade. I exited feeling I had gotten lucky rather than made a sound trading decision. So think about that for a second. For those of you that are listening to me but tuned out doing other things, if there's one moment to listen, now would be a really good time. This person said they took a trade and they felt very chaotic during the trade and uneasy, and they have no idea if it was a good trade. Does that sound like a great idea? So think about that. Think about what you're saying. I want you to imagine that you have some really, rich uncle or rich cousin, and they just said, okay, here's $1 million. And what we're going to do, you understand this trading thing, or you at least have been studying it. I'm going to give you $1 million in this brokerage account, and you keep half and I keep half. Would you take that exact same trade? My assumption is you would not take that exact same trade. Why is that? Because now the stakes are a lot higher. One of the things, I see this a lot, and I've been guilty of it thousands of times, is we do something and we're not quite sure if it's a good idea. You're not going to have certainty when you're taking trades. But the problem is that if you don't have the right expectation behind the trade, you will have no idea if that trade is actually hurting you or if that trade is actually helping you. So as far as your trade goes, it was reasonable to sell the close of 46, and then 47 was follow through. We were likely to go lower. So yes, you did the right thing, but you actually did the wrong thing. Now, how is it the fact that you made money and therefore you were in the right direction, so you did the right thing, but how is it that you did the wrong thing? Any guesses on that? How can you have a trade that works and I'm sitting here saying it's a good trade to take, but it was a bad trade for you? Risk wasn't managed. It's not the risk. We don't know what this person's risk was. So what's the answer? Because I'm saying this trader was absolutely wrong in that trade. Yeah, exactly. Peter Rabbit got it 100%. They didn't know the expectation behind the trade. You should understand the probabilities behind the trade. You need to know what the probability is to a degree. And you have to, so in other words, you have to define what success is and what failure is, and you have to have a reasonable probability expectation behind the trade. What you cannot control is the distribution of that probability. But if you do not have a reasonable expectation behind the trade, you have no idea how to manage it. That's one of the reasons why traders continuously lose money. I'll quote Al back in 10 years ago. He said this. There's actually an Ask Al video on the Brooks Trading Course website. Plenty of traders take plenty of good trades to do really, really well and have a good living with trading. So why do they lose money? Because they have too many stupid trades. A stupid trade, I think of a stupid trade as one where the risk reward, the management, in other words, I think of a stupid trade as poor trader's equation. It's just bad math to begin with. But I also think of a stupid trade as one where you don't know the expectations behind the trade. I like to think of it as if I'm at a hedge fund, if I'm, to coin Al, if I'm working for Goldman Sachs, do you think that I could take a trade and have no idea of the expectation behind the trade? Of course not. I'd be fired probably instantly. And if I wasn't fired instantly, it wouldn't take long for me to be fired. Could you imagine working for an institution or a hedge fund and you explain to your compliance department or your risk management department, oh yeah, I took this trade because, I don't know, I thought it was a good trade. I don't really understand the math behind it, but took the trade. And I see, it seems like I'm being hard on this person, but this is one of those kind of cold, hard truths about trading. The reason why traders don't really, the reason traders don't want to have to figure out what the expectation is behind the trade they're taking is twofold. One, there's a couple of reasons. One is that means that you would only be able to take one specific trade until you figured out the expectations behind the trade. And then the other is you would actually have to do the work to figure out what the expectations are. So there's all sorts of ways to figure out expectations. So I challenge you, go back on the recording. I just explained how you could build a breakout method, some kind of breakout trading rule-based system. All this is basically talking about a trading plan. But if you do not understand what you're doing, and more specifically why, and the success and failure of the trade, you're going to be in a rough spot, and that's just reality. And if you're doing well at the moment, to this person's question, you're going to do a lot better if you take that advice. Okay, question. Al usually mentions if we gap up far above the average price and we get a decent bear bar, traders usually start to sell it. Was today a different context? Secondly, bar 2 would have made a trading range. Would we have known it was a buy before seeing a follow through? Well, for one, it depends on the price action to the left. But when you're talking about the open, this is what you're trading against. When you see this bear bar, you're buying this right here. You're buying this bar as it's going below the small bull bar in a 1, 2, 3, 4, 5 bar bull macro channel, and therefore buyers below. So when you see a big gap up in a bear bar, what matters is the overnight. What matters is the Globex session, the bars to the left, and therefore you can't see the Globex session unless you're looking at it. That's why it's generally better to wait. Most traders will do much better if they just wait for 6 to 12 bars before taking a trade. All right, so looks like there's no other questions, and there's one more. Can we consider bar 46 high to the 54 low a trading range? Bar 46 high here to the 54 low a trading range? Sure. And this is the upper portion of the range, lower portion of the range, and we went sideways. All of that makes sense. So where do we go tomorrow? Bulls won't follow through buying tomorrow, and if they're lucky, they'll try and get a reversal on the weekly chart. So if the bulls are lucky, we'll get a strong bull bar closing on its high. But realistically, I suspect there's going to be something disappointing about this bar. Not a great buy signal bar above, and therefore if this is a doji, next week might sell off and form a higher low, and then we bounce. But we'll see. All right, thanks everybody for tuning in. Hope everyone has a great rest of the day, and I will talk to everybody